research before investing in those ideas and themes. So today in this session, we are going to discuss how the year 2025 was. And then I'll also discuss about some of the key events which has impacted the market, some sort of macroeconomic view that I'll be discussing. And then my colleague Vijay will discuss about some of the sectors, themes that we at RH PMS are bullish about, and we have constructed the portfolio around it. Right. So starting with a review of 2025. So it was very eventful year. It was a year in which we have a lot of macroeconomic factors impacting the domestic market. So we started the year on a very weak footing. The GDP growth was kind of plummeting, as well as the earnings growth kind of bottomed out in the last year, quarter two. So as we entered 2025, we started with a bit of monetary easing as well as fiscal easing, right? So mainly the RBI has gone for a 1% rate cut, sensing some bit of weakness into the economy, as well as government has also during the budget, right, has proposed for a has gone for a a reduction in the income tax bracket rate. So that has also was some bit of stimulus for the economy. And as we move forward, right, so the earnings growth kind of started to pick up from quarter one of this financial year onwards. And there was also some bit of tariff overhang around that, right? And finally, in August, the tariffs were levied, which were kind of negative event for the market. So we have seen outflows from the FIIs is in response to that. And after that, punitive tariffs also came into effect from the August end. So that was also a kind of trigger for the market to weaken further. But there was some bit of rebound in the discussions between the India-US trade delegations. So we see the market to go up in the month of October. And there was also some bit of policy response from the government to tackle the tariff impact, right? So government has gone for a GST rate cut, which was a big reform in itself, the simplifications of the GST slabs. So that was also a stimulus for the market to go up. But very recently, what we have seen is that the rupee has started to depreciate further, right? And it has weakened to a level of 91. It has weakened around 4 or 5% in this financial year. So that was mainly because the trade talks that we were having were kept in the back, were kept on hold for now, right? And we don't see that coming to fructify in this financial year. And also there was some bit of higher imports that we did in the month of October around the festive season, right? So our gold imports were up around 3x in the month of October, right? So that has led to further weakness on the currency side. But overall, the main positive thing that we take forward from this year is that the earnings are started to revive. Whatever the policy actions that the government has taken, both on the physical side as well as the monetary side, taken by the RBI. In fact, very recently, the RBI has again gone for a 0.25 basis point rate cut. So those sort of triggers have revived the economy. We are seeing the green shoots in the earnings revival side. Again, we have seen the quarter two be as the first quarter over the last 4 or 5 quarters, where we have not seen any material downside or downgrades in the earnings, right? So as we enter into the 2026, we are entering with a very strong liquidity position. We are entering with a loose fiscal as well as monetary policy, and we are entering with a hope that there will be a revival in the earnings in 2026. And also, we forecast that in the first quarter of next year, there will be an interest rate cut by the US Fed as well. That could be a further trigger for the emerging markets to rally, especially countries like India, which have been lagging so far. So that was a brief on the 2025-26 side. Now let's talk about the market, how the indices have performed in this financial year, in this calendar year. So Prabhu, if you can just move to the next slide. So, the Nifty has hit a high. In fact, the mid cap index has also hit a high in the month of November, right? And on a year-to-date basis, we are marginally down around 0.5% in the Nifty and 0.4% on the mid cap side. But if you look at the underlying stocks, right, of the market, so we have seen a very large sort of drawdowns. In fact, most of the companies which are there, right, especially from the small cap side, micro cap side, or some bit of mid cap side as well. So there has been sustained correction into the market. So the first phase of the correction was between January to March period, where we have seen a sharp price correction. Post that, what we have seen is a time-wise correction into the market. And the stocks have yet to go up and make the new all-time highs, although the index has delivered the all-time high. But the underlying holdings are still kind of corrected from their 52-week high levels, right? For example, the small cap index, the median correction is around 23%, right, which is very high. And again, for the mid cap, it is around 13%. So the correction is still on the higher side, and the the revival in the stock price is mostly seen by the index name and some bit around the large caps and the mid cap index side. Broader market has yet to participate in that rally, and from a long term view, right? So this puts a very ideal position for somebody who is looking to build a portfolio across the mid and small cap side, right? So we have completed a time correction as well as price correction phase of 12 to 13 months. Typically, what we have seen is that this cycle lasts for 15 to 18 months at max, right? So we are at the fag end of that bear market, and somebody who's looking to build a portfolio around it, around the small and mid caps. So the kind of correction and the in the valuation as well as the price and with the prospect of earnings recovery, it's an ideal time for somebody to build a portfolio around it. Now, moving forward, just to understand how the FI, the tariff impact was there. So mainly in response to the punitive tariff of 25%, right? So we have the highest tariff among all the countries which are out there, right? And especially our exports are not competitive now with respect to the neighboring countries like Bangladesh, Sri Lanka, and especially also now with China as well. Now that China has also reached a agreement level with the US on tariff side. So the government has come up with liquidity measure to revive the domestic economy. So in all, if we look into the cumulative aspect of it, so there has been around 5.5 to 6 lakh crore of liquidity injection through GST cut, income tax rebate, interest rate cut, eighth pay commission that the government will be doing into the economy. And that's very massive. We have not seen something like that happening post global financial crisis. So last time that has happened, it was around GFC when government has gone for liquidity injection as well as interest rate cut, right? So this monetary and fiscal loosening that we are seeing right now, it's kind of unprecedented and it's at a very massive scale. So the impact of that will be seen in the economy, right, in the coming quarters for sure. And also, what we have seen is that to balance out the trade, so government is engaging with other countries to go up and do the FTAs and create more export opportunities for the domestic exporters, right? For example, we have signed FTA with UK, and very recently, we are also going to sign a FTA. We are in discussions of FTA with Eurasian countries, and again there are FTAs which are currently being discussed with the European countries as well as the Australian and the New Zealand countries. So all in all, government is trying its bit to open up the export market. What we have seen after the punitive tariff was that the export to the US has gone down by around 10%. On the other side, the export to the other markets except US has gone up by around 11 or 10, 11 odd percent. So in a nutshell, we are trying to balance out the negative impact of downfall in the export to the US through engaging into meaningful export to the other countries. But it was a festive quarter, so we have seen large exports, and our trade deficit has ballooned to around 40 odd percent, right, in this specific quarter. But overall, as we go forward, towards FY26, the expectation is that, some bit of trade certainty will be there in terms of tariff reduction, and the export that we are losing to the US will be coming back to us. Also, that depreciation in the currency that we are seeing currently, so that's going to help the exporters and to make the export more viable going forward. Prabhu, if you can just move to the next slide. Yeah. So because of the depreciation in the currency, what we are also looking at was that it was the year in which we have seen a higher level of FIA outflow, right? So the FIA outflow is roughly around 2 lakh crore for this financial year, this calendar year. While on the other hand, the DI has been a very silent sort of supporter for the markets, buying around 7 lakh crore, which was kind of again unprecedented. So in game of liquidity, the DII now holds roughly around 16% of the Indian market, and the level is down from 21% around 3 years back, 4 years back that they used to hold. So if we look at the other counterparts to India, right, mainly like countries like Taiwan or China or let's say Korea. So there we have seen sustained sort of foreign flows to go and invest mainly because of the AI theme. India was emerging as a anti-AI play, right? So that was also the reason that we have seen the capital to move out of the Indian economy to like other economies where there were evident AI plays, right? But now that AI story is coming to a maturity, there are already discussions happening of a bubble in the AI, right? So it's very early to call that a bubble. But again, the investors have taken extreme position on those segments, and there could be a reversal in the AI play going forward, which will bring back the flows to the markets which are considered anti-AI like India. Again, the correction started and the outflow started with slow down the earnings. Now that the earnings are kind of recovering, so we expect that as in soon, as and when we'll be hitting a double digit mark in the earnings growth. So there could be a reversal in the FII flows to the Indian economy. And DIA money is very sticky in nature and it's not going anywhere. So it's continue to be supporting the market and keeping the valuations elevated going forward. Now moving on, just to understand how what has happened on the currency front. So over the last 25 years, we have seen around currency to depreciate by 3% on an annual basis, right? It's never linear like equity market. So some years we have seen a larger drawdown in the range of 5 to 8% or 10% also. Some years we have not seen a material sort of drawdown into the market. So as we enter 2025, the currency market was kind of overvalued, right? And what has happened is that the market, the USD INR pair is again kind of rebalanced, right? And whatever the overvaluation was there on the currency market for USD INR pair, it has given way, and we have seen the currency to move from 84 to 88 level, right? But in the last 2 odd months, because of the heavy imports that we have seen, and again because of the delay in the signing of India US trade deal, we have seen the currency to slide further to 91 level, right? 90 odd level. So in a very near term, if there could be no deal, we can see the currency to even slide up to 91, 92 level. If there could be a deal, we can see the currency to go back to 81 pair, 88 pair. And in case we have a very favorable deal with US in terms of not a mini deal. In case we have a full-fledged sort of trade deal with the US, and also if crude stays below $75 mark, we can see the currency go back to 84, 85 level, right? But considering we have a very slow pace of CPI inflation in the economy, WPI inflation is practically negative for the last month. So depreciating currency was the logical role for the RBI as well as the government to make the exports competitive, right? And again, a cheaper currency brings in more foreign revenues from the remittances for the IT companies, IT export that we do, IT services export we do, as well as the pharma exports that we do. So to make the export competitive for the sectors which are affected because of the tariff, the currency has to depreciate along with other reasons that I've mentioned. So that has already played out, right? The one sort of drawdown or drawback of this currency depreciation is that the capital markets outflow by the FI investors. But that is also done now, right? So considering that we have already depreciated from 84 to 90 around 90 level. So going forward, we don't see any sort of major correction happening, right? In case there was no trade deal in the next 2 to 3 months, we can see the currency to further depreciate by 1 or 2 rupee more. But more than that, we don't see any sort of major chances of correction in the currency market. Now moving on. So one of the key events that are investors watching out for is the Fed rate cut. And what historically we have seen is that cut is actually the positive. The interest rate cut is actually a positive trigger for the markets. It reprices the intrinsic value of the securities. So the security prices and the Fed rate cut, the interest rate cut, are basically the inversely related, right? So as we reduce the denominator, right, which is the risk free rate, the risk premium into the market, so the security prices go up, right? So as and when there will be interest rate cut in the US market, that could be a trigger for the market to further rally. Historically, what we have seen that 1% interest rate cut leads to a 15% rally into the market, right? So for the US market, more of it is already factored. For the Indian market, we have not seen that, factoring yet. we are still into the time correction and the price correction phase. So going forward, if there will be further rate cuts into the US market, it will be a liquidity event for the Indian markets as well. Again, it will be giving a respite to the currency pair, right? So the expectation is that there will be three Fed rate cut in the first half of 2026 that will keep the dollar index level within 100 range, and that could be a trigger for the INR to strengthen a bit against the USD pair, and that will trigger some bit of more flows as per that, the capital flows into the market. So that was the view on the interest rate side. Now moving forward, let's talk about the valuations. So currently what we see is that Nifty is kind of favorably valued at the current valuations. If we compare that with the 5-year average P, mid cap is slightly elevated for a reason that the earnings has been pretty strong for the mid caps. For quarter 2 FY26, the mid cap index has delivered a 27% earnings growth, and for the small cap 20 250 also, the valuations are in line with the long term averages. A little bit we have seen a sharp recovery in the earnings in the small cap space. For a long-term view from 25 to 27, the earnings trigger will be there mostly into the mid and small cap side. Also, if we compare the 1 year return of the market with respect to the 10-year average, so what the market has delivered is on the lower side. And on a 10-year basis, the Nifty has delivered roughly 13% CAGR return. Mid cap has delivered roughly 17.5% CAGR return. Small cap has delivered roughly 14% CAGR return. In comparison to that, the market has delivered just 8% for the large caps, 7% for the mid caps, and minus 5% for the small caps, 250. So this means that we have gone through a very swift time correction phase into the market as well as price correction phase. And going forward, for the next 3 to 5 years, there is no growth into the market. The earnings will be supportive of the rally, and we'll be seeing some bit of meaningful earnings as well as the returns to be made from this mid and small cap segment. And there are ample triggers for it. So let's just discuss those factors that will be impacting the market in a positive way going forward. So moving on, Prabhu, if you can just move to the next slide, please. Right. So the first and foremost is the sticky SIP flows. In the last 7 or 8 odd years, what we have seen is the SIP flow has grown at a CAGR rate of 27-28%. If SIP flows continues to grow by this range over the next 6 to 7 years, we will see the SIP monthly SIP flow at roughly around 1 lakh crore per month. And that's a very big number, right? So the worst inflow that we have seen was in this year around 2 lakh crore to 3.5 lakh crore last year, right, from the FII side. And against that, we are seeing a 1 lakh crore of domestic inflow coming into the market every month. So that's a very big shift in the dynamic in the supply and demand for the domestic equities. So even if foreigners have to sell, there will be ample sort of buying coming from the domestic investors to overcome that selling and keeping the markets elevated, right? So the domestic sort of flows has been very sticky, right? Despite the sharp correction that we have seen earlier. What used to happen that whenever there was a correction, we used to see a dip in the SIP numbers, the net inflow numbers into the markets. But this time from April onwards to October, or in fact January to November, we have seen a very sticky nature of SIP flow coming into the market. And these are the investors, they want to acquire asset at every price, acquire the equities at every price. And that has been a very positive factor for the markets, and that has helped in keeping the valuations elevated for, let's say, mid caps or small caps. Now, moving on, the returns that we have seen for the domestic markets has been on the lower side. So this year, most of the returns has been made by the global counterparts like Nasdaq, or for the US markets or German markets, or even the emerging market basket as a whole has delivered 28% return, which includes market like Taiwan, Philippines, that of Korea, Japan, China. So all these markets have some bit of AI plays. And again, these markets are very concentrated in nature, right? So for example, Samsung accounts for 30% of the Korean markets, and most of the inflow was there into the Samsung for the AI play. Taiwan SMC has TSMC has around 40-45% market share for the Taiwanese index, and most of the flows is going towards that. So it's not a broad-based rally that these global markets have seen. This was just a pocket of AI which has seen the massive inflow, which has led to the rally into that particular stock. And since these stocks are the heavyweight of the index, that has also led to the rally of the global counterparts, right? Mainly the Asian peers. But going forward, we don't see that to play out. In fact, our premium to the emerging markets is has declined to 55%, which is at the lowest level in last several years, right? So that's a key trigger for global investors to book some profit and reallocate to NTA theme, or theme where the earnings growth is. So for example, India will continue to be the fastest growing country in terms of GDP. Indian market has seen some bit of decline in the earnings, but going forward over the next 2 years, FY26 and 27, over the next 7 to 8 quarters, the earnings growth will be sharpest for the Indian market versus the global peers. And that could be a trigger for the money to rotate back and come back to the Indian market. In fact, we have done an interesting exercise to study how the forward return of the Nifty is linked to the emerging market underperformance. So, Prabhu, if you can just move to the next slide. Yeah. So this chart basically captures the Nifty MSCI emerging 1 year rolling return. So difference of Nifty versus the MSCI emerging one year return, and also the 1 year forward return. So what we have seen is that as and when the difference is kind of on the negative side. In fact, the Nifty has underperformed the MSCI emerging market. The 1 year forward return has been very positive for the Nifty. For example, take into account the years the 2019 or 2020, or for example 2016 to 17, when the Indian market has underperformed the emerging market peers. And there on, we have seen sharp rally in 2018, 2017, or let's say 21, from the Indian markets. So currently also we have seen underperformance of around 14-15% versus the emerging market. Normally Indian market trades at a 11%, the average outperformance of Indian market is around 11%. So that positions Indian market for a 25 to 26% kind of outperformance over the next 2 to 3 years over the emerging markets. So these are the key triggers that we are watching out for, and that's giving us hopeful that the Indian market will find its mojo back and will outperform the emerging markets going forward. Now moving on. We also have to understand how the small cap has performed, right? So it is the segment which has been battered in the last couple of quarters, and the returns has been kind of dismal, and index is yet to see a meaningful upside, right? So for example, Nifty and the mid cap index has already made all-time high. The small cap index is still down around 14-15% as on date from the 52-week high levels or all-time high levels, right? So if we go back and study the last two cycles, right, when the companies have kind of done a cleaning of their balance sheets, their ROA has improved, their ROE has improved, that debt to equity level has gone down. So in the last two cycles of correction from Jan 18 to August 19, it was the 18 months of correction period in which the drawdown was around 35%, right? For the 18 months period. And after that, we have seen a 157% kind of upside from the market. Similarly, that because of the Russia-Ukraine war, the Indian markets in the Indian small cap corrected by around 25-26% between January 22 to June 22. And that time correction phase lasted up to March 23. But after that, also, we have seen a 150% kind of upside over the next 18 months. So we are also in the similar cycle, like the market has given a 26% kind of drawdown, and now we are in a time correction phase. So it started in December of 24. If we go by the past cycles, how it has behaved. So we can see some bit of, we are at the end of the bear market, right? And we are just 1 quarter and maybe 3 or 4 months away from the market to make all-time highs level. So these are again going by strictly by the historical sort of analysis that we have done. In reality, there are a lot of factors which will be impacting the market, like agreement on the tariff, revival on the earnings. So we'll discuss that in the next slide. Prabhu, if you can just move to the next slide, please. But before that, just also a quick sort of analysis how the market was in 2018 versus 2025. So there were pockets in 2018 correction as well, where we have seen very significant drawdown, right? For example, market cap below companies below market cap of 3,000 crore. So there was average decline of 67%. Companies in the range of 1,000 to 5,000 crore, there was average decline of 67%. So so there it was actually a very brutal market for any small cap or micro cap company at that point of time. And we have seen the cycle repeating in this correction as well, where companies which are like, in the market cap range below 1000 crore, uh, they have given a massive drawdown of 55% to 58%, right? And these numbers are up to, I think, November end updated. So the correction has been again 3-4% higher now, since the December is not turning out well for the small and mid caps. So this number could be again in the range of 60% now. So we are very close to what the cycle ends look like, right? And most of the price correction for the large part of the market is already done now. And from here on, the whatever the growth was there last year into the small and mid caps, right? That's mostly gone away. And the prices, if you look at the companies, we are finding a lot of companies on a forward basis which are available at a 10x P or 15x P, between 10x to 15x P, right? So it's a very ideal time for somebody to start building portfolio. What happens that in a bear market, even the good news are not discounted by the market, and be the bad news or bad disclosure by the companies are actually battered, right? So they are hammered left down, left, right, and center. So there is a sort of undervaluation there in that space, and we are trying to identify those companies and take down those opportunities and create a portfolio for our investors. So so it's an ideal time to start building a portfolio into the small and mid caps. If we have money, you are already invested. So again, a good time to do a top up, right? So we have all seen the cycle from 20 to 22 or 23 to 24, what it looks like. So it could be a similar sort of repeat that we have seen in the previous cycle going forward as well. Prabhu, if you can just move to the next slide. Yeah. So this is our view on the market, right? On a long-term basis, 3 to 5 years, we are kind of neutral on the large caps. We have seen there is no extra trigger for the markets to re-rate the index. While on the mid and small cap side, we remain very optimistic in terms of short term as well as the long term. Small caps, very near term, we are kind of tactical in nature. We are very neutral because, this is the space where any sort of negative news could impact the price behavior of the small caps. But on a long-term basis, maybe 6 to 12 months, on a tactical investment point of view as well as strategic investment point of view, the mid caps and small caps remain very sort of favorably placed into the matrix. And we are very hopeful that a long-term basis, these are the segments which will be delivering superior earnings growth as well as the return versus the large caps. Now, just to discuss on some of the key rationale and themes, Prabhu, if you can just move to the next slide. We have discussed the slides already. Prabhu, if you can move to the next slide. Yeah. So just to quickly discuss on the portfolio side, BSE 500, super value, and the performance of core equity portfolios for Q2 versus the index. So the operating profits for the super value is roughly around 34% revenue growth, 32% PAT growth versus 7% PAT growth for the BSE 500. So what it shows is that we have carefully created a portfolio of 25, 26 odd stocks where there is a earnings tailwind, right? And for this entire financial year and calendar year, for 2026, we have seen similar sort of return earnings growth profile for our portfolio. But the returns are not there in the market because there is some bit of risk of sentiment for the small and mid caps. But normally what we have seen as the sentiment changes from risk off to neutral, or let's say risk on as well. So whatever the gap in the earnings growth that the portfolio is delivering versus the index, that that gap basically narrows and also fills, right? So mainly whatever the stock price performance that we are seeing, that will replicate the earnings growth going forward, and we'll be seeing we are hopeful of seeing outperformance versus the index once the risk on mode resumes in the market. So with that, I would like to conclude my section. My colleague Vijay will discuss some of the key sectors and themes that we have included in the super value and flexicap portfolio, and he will discuss on the case studies as well. So over to you, Vijay, now. Thank you.
Yeah, thank you, Prabhat. Now we'll move on to the next section. We'll focus on the themes and we will also discuss some of the key growth drivers before we deep dive into the themes and stocks. So just a quick disclaimer. So whatever themes and stocks that we'll be discussing again in this part are only for the educational purpose, and you can do your own analysis before taking any position into the same. Uh, so when we are looking at the upcoming cycle, so we have identified several key growth drivers which will act as a bedrock for the upcoming cycle. And some of the key ones that we have highlighted are ranging from government capex, where government has budgeted around 11.2 lakh crore for FY26 side, which is around, and we are expecting it to grow around 10 to 12% CAGR for next 4 to 5 year perspective. PLI scheme, which is again linked to production link incentive scheme, which is aiming to boost the manufacturing share, which is currently around 17% in GVA to 21% in the next 5 years. And we have already seen very good results from the PLI side. It has generated almost 16.5 lakh crores of sales with a capital outlay of 1.97 lakh crore. And now another 12 lakh jobs are also created through direct and indirect mode. Again, we have seen a lot of expansionary moves or policies from the government side in terms of cutting down the tax rates across income tax or GST. And again, monetary side, we have seen the like expansionary monetary moves, cutting down of rates from the RBI side as well. The fourth is the energy transition. So we are at around 210 gigawatt from the renewable energy capacity side, and we are gearing up towards the 500 gigawatt by 2030. So that is also a big theme that is a key growth driver for the renewable energy push. Again, the fifth one, which is a classic, which is a China plus one from the diversification point of view from the global perspective. Sixth is a financial savings. So basically, we are expecting the financialization of savings for the upcoming decades, and we see the share of financial wealth on individual basis to go up. And the last one is the rising per capita income. So as GDP per capita goes up, so it directly translates into the higher income per capita basis, which will also trigger a lot of discretionary consumption going ahead on various sub-segment side. So these are the key growth drivers in our humble opinion that will drive the upcoming cycle. And now we'll move on to the emerging themes. So first theme that we will like we are bullish of from the RH perspective, the wealth management. So as we were looking at the past slide, so we were focusing mainly on the rising GDP per capita, which will translate into the higher income per capita, and typically then people will have higher surplus income. So which will some part will be spent behind the consumer discretionary products or services, and some will be invested into the market or maybe some other fixed income products. So that will push the need of the wealth managers in India. And if we compare India with some of the peers who have already gone through a journey like a US, which is a kind of like a matured and developed economy. So if we look at the wealth to GDP ratio, it's around 6.5x versus India is around 4.5x. Share of financial wealth is around 70%. India is around 25%. And again, the wealth of that portion, which is managed by the professional wealth managers, it's around 75%, which is quite huge penetration in US, and India is around just 15%. But the journey of reaching from 15 to 75 is not easy, and although it will look simple on the year over year basis, but it will take a lot of time and initiative also, or the push from the SEBI side or even the regulator side or even the at an overall side. And we think like it will be a multi-decadal theme. And recently, like last year, MFI had come up with the vision 2047 for the whole mutual fund industry. So we were at around 52 lakh crore at March 24, and we are expected to reach around 2800 lakh crore by the 2047. So which is around 52x jump on that side, and around 18% CAGR for the next 20 to 25 years. And we are already on track. So we have reached around 79.3 lakh crore as of October end. So that is a very healthy traction from 52 to 79. And similarly, we expect the HNI population for the by 27 to reach around from 8 lakh to around 16.5 lakh. Of course, the definition of HNI that we have considered is above $1 million of financial like net worth in terms of perspective, when we are looking at $1 million net worth, which is around roughly 9 crore at the today's USD INR rate. So this is a theme like we believe like we'll have multiple legs over the multiple decades, and we remain quite optimistic about the prospects of it. Now moving on to the second theme. So second theme comes out from the healthcare side. So as India is growing towards a $10 trillion mark in terms of GDP, so the strong healthcare network is also mandatory when countries passing through a journey of developing to developed economy. And if we look at some of the metrics which is mandated by WHO, so as per WHO, we need around 3 beds per 1,000 population. So at 1,000 population, if we look at from the India side, we need at least on 145 lakh or 145 crore people, we need at least 40 to 43 lakh beds. And if we look at the last 78 years of addition in terms of the hospital beds, so in India, we have only 19 lakh beds as of now. And half of them, let's say 40% is coming from the government side, which is the public sector, 7.1 lakh crore, 7.1 lakh. And around 12 lakhs are coming from the private sector sides. And if we look at this ratio for the India, it's only 1.3 beds per 1,000 people. So there is a huge gap when we compare this volume number of 1.3, this ratio with some of the developed players. So we think there is a long way to grow. And what we have witnessed is in healthcare, so there is a quite high capital efficiency, and there is very high terminal value when it comes to running such kind of businesses. And also there is a certain kind of stable pricing power from the hospital player. So that acts as a very good multi-decadal wealth creation for this as a sector at an overall level. And also some of the individual themes or some of the individual stocks from this space can do exceptionally well. So we have around couple of holdings from this space in Super Value and FlexiCap as well. Yeah. Now the third theme, we can move to the next. Yeah. The third theme is from the defense side. So as government has become like quite focused on the boosting the domestic manufacturing on defense side, and we have witnessed a lot of push by various in terms of defense expenditure. If we look at, so there is a steady increase, and we have reached around 6.8 lakh crore for the FY26. And out of that, so typically this defense expenditure has around three components or a large level. One is the capital outlay, which is basically you're buying new weapons and systems. Second is the revenue, which is the basically salaries of the army personnel. And third is the pension. So around out of that 6.8 lakh crore, 1.8 lakh crore is allocated towards the capital outlay side. So which will be procurement of new arms and weapons. And what we expect going forward is the overall defense expenditure will grow in line with the real GDP growth rate, around 6.8 to 7 odd percent for the next 20 to 25 years. But the capital outlay, which is the procurement of new items, new technology and the weapons, so that will accelerate, that will grow more than, let's say, around 9 to 10% kind of levels, almost 1.4x of the defense expenditure. And we expect it to move from 1.8 lakh crore to around 10.4 lakh crore by FY47. And the share of capital outlay, which is around 25% today, will also go up to 36%. And government also very closely tracking this metric. So government has set up the target of domestic manufacturing on the defense side to 3 lakh crore by 29, and 50,000 crore of exports by FY29. And if you look at the current progress, please move to the next one. So in recent year, the 2025 numbers are already out. So we grew around from 1.27 lakh crore to 1.54 lakh crore in terms of the production. It's a decent jump of 18%. And if you look at the defense export, so it has also moved up 12% from 21,000 crore to the 23,000 crore. And if you look at the current year number, so we are already on track to reach 1.75 lakh crore on the domestic production side. So we see healthy traction, and government is also keen and doing frequent announcements on this space. So we think like this will be there will be a natural tailwind from the government side, and the recent war related activities and the border issues have also amplified the focus to adapt, or let's say adopt new technologies or procure new sorts of armories or the new generation weapons for the country. So this will remain one of the key theme that we will be investing for the upcoming cycle. Now, the last theme. So last themes comes from the EMS space, basically the manufacturing, which is again a push from the government through PLI scheme of 1.97 lakh crore capital outlay. So if we look at the Indian electronics market today is around 15 trillion, and we are expecting it to reach around 41 trillion by FY30, which is around 22% growth CAGR. But what we are interested is into the domestic manufacturing, and a part of it is the EMS. Out of this 12 trillion, around 31% comes from 31% is the Indian EMS space, which is electronic manufacturing services. So that will be growing at a 32% CAGR, almost 1.5x of the Indian electronics market, and it will reach around 15 trillion, forming 41% pie of the overall manufacturing, domestic manufacturing space. So this is a quite healthy growth rate if we are comparing it with the other industries which are available in the Indian side. And this is quite at an early stage, this Indian industry. And one of the subspace of this EMS space we like is from the OSAT side. So Prabhu, please move to the next one. Yeah. So if we look at the OSAT market, so we can say our OSAT market is very small. So basically OSAT stands for the outsourced semiconductor assembly and testing. So basically once your this wafer is manufactured, so typically you outsource the assembly and testing part to some third party. So this is where the OSAT market lies in India. So we have only $35 million as of now, this market, and it expected to grow around 6 times by FY28. So it's almost will reach $200 million. It's a quite attractive opportunity, but we are also very careful because this is a new market which is emerging in India at a very rapid pace. So there are also lots of accidents which can happen in this space, and we are cognizant of the fact, and we are evaluating some of the opportunities in this space. But we remain very bullish, looking at the growth rate that this industry will generate over the next 4 to 5 years. These are the few themes that we are quite bullish from FY26 and beyond, and we also keep close track on the developments of the each industry, even it let it be some positive or negative development, because it reinforces our trust in terms of like how they are dealing with the problem in particular industry. So now we'll move on to the next section where we'll quickly discuss on some of the case studies. Yeah. So first case study comes from the fashion retail space. So one of the company that we hold in our portfolio is the V2 Retail. So we met the management early 2024, and it operates around, as of now, operates around 23 states, around 259 stores, and they are present around more than 195 cities, and they are continuously boosting their new stores. So it's basically focusing on the eastern part of India. So if we look at the Bihar, UP, and Odisha are the large market for these guys. So basically, these are the key states for V2 Retail. And if we look at their like the segmentation where they are focusing their products, so they are typically the ASP of around 300 rupees, and the average order value, or you can say average bill, is around 900 odd rupees, and their sales per square feet is around 958. So it operates little bit on the value side of this thing, and it has been able to generate very strong growth. Even in Q2 numbers, the growth was more than 80%, around 85 odd percent in terms of revenue, and they were able to add around 72 stores in the FY26 and first half of FY26, and they have also increased the guidance to 130 stores for the whole year, and also for the FY27, the guidance has been raised to 150 stores from 130. So, and the SSSG growth that companies expect around 8 to 10%. So there is a decent execution from this particular business. And when we onboarded this business, so it was around 456 on our lowest entry level point, and today it's around it made all time of around 2564. But what part is important, the framework that we have developed internally. So if we look at the EBITDA growth, so in this period, since we onboarded, the EBITDA growth has been around 2x, and the multiple rating is around 2.86. So majority of the return has come from the discovery part. So that is why we are mainly focused on the finding some of the themes which are not discovered in the market. But whenever we are dealing with small and mid cap, or typically the small cap and micro cap, so earlier slides where we were where my colleague was focusing, so there are also sharp drawdowns, and we have to live through it so that we can see these kind of massive returns or the good returns in the long term. So a similar case studies, the second case study comes from the discretionary space only, which is the Sky Gold and Diamonds Limited. So this is a B2B jewelry manufacturer. So typically this player manufactures gold and jewelry for the B2C players like Joy Lucas, Malabar, PNG, Kalyan, and all. So when we met this management in 2024, so they were discussing with some of the new players like Carrot Lane and basically this PN Gadgil and Aditya Birla. So they onboarded later on in the subsequent quarters, they onboarded new clients. They increased their capacity from almost 250 kg to 1050 kg per month. And now they are again going for capacity expansion in a near future to 4,000 kg, which is 4 ton per month, which will be typically the second largest facility once it comes online. And the execution is again phenomenal. So in a recent quarter, did again almost 90% revenue growth with a margin expansion, and they've also revised the guidance of the revenue upwards from 6,300 crore by FY27 to almost 7,600 crore. So even in the rising gold price environment, they have been able to deliver the price growth as well as for the volume growth. So currently the volume growth, if we look at from the last year perspective, so it was more than again 50-60%. So it was doing around 350 odd kg per month in the quarter to last year. So they had hit the volume around 544 kg per month for Q2 FY26. So that is been a decent jump. Even the rising price of the gold did not deteriorate the fundamentals of this particular business. So we remain optimistic on both of these businesses, but we understand like there will be, because these both businesses are coming from the small cap side. So we have to be also careful, like the developments which happen on the, let's say on the day-to-day operations or on the quarterly side. So we remain optimistic on both these businesses. And in summary, like now, we believe that the majority of the pain is behind us, and the initiatives or the efforts that have been taken by the government in terms of the capex push on the H1 side, even the GST cuts and the income tax cuts. So those will all act as a tailwind for the upcoming cycle, and we have already started to see the green shoots in Q2 earnings growth and also the Q3 outlook. And we have also seen a very robust Q2 GDP growth number. Of course, little bit there was a miss on the nominal GDP side because of the lower inflation, but we are expecting it to reach again double-digit nominal growth by Q1 FY27 somewhere around. So we remain optimistic on the recovery in the small and mid-cap space side, and we think like from a perspective of let's say 4 to 5 years duration. So somebody who is like okay or let's say in line with the risk that small and mid cap brings, so one can look to play this upcoming cycle by estimate because the still valuations are reasonable. But we have to be mindful that this journey will not be smooth. There can be some intermittent hiccups, but in the end, the journey can be quite rewarding.